work in our professional practice in a more informed manner. So we do have a lot of, we have held a lot of sessions where we've tried to give some practical insights to the people who attend. And we hope that it's been of value to all of those who have attended. All of our programs, of course, are also available on the website and recordings are there. So those who need to go back and look at them, they are always welcome to do that. I must thank Shilpa for having organized so many programs because that's, I think, the key to our Bangalore Valuers Association being repeatedly used by most of our members. All our members, of course, have joined this association because we believe that we're going to have something which is of value to us, and I hope that we continue to deliver on those expectations. So, with the short introduction, let me hand over to Shilpa.
Good morning, everybody. I request Jivika to formally introduce the speaker to all of us. Jivika, are you there? She has logged in. She just... Jivika?
Yeah, Shilpa, I'm here.
Yeah.
Shall I start?
Yes.
Okay, good morning, everyone. It's my privilege today to introduce Mr. Sameer Verma, who is the speaker for our first session today. So, Mr. Sameer Verma is the co-founder of Alpha Value Consulting and a registered valuer with IBBI and fellow member of the ICSI also. He holds postgraduate diploma in international business. He possesses rich working experience of over 10 years in investment banking in the area of valuation and financial advisory. He has proven record of business acumen in leading and managing the operations and contributing higher rate of organic growth. He was earlier associated with one of leading SEBI registered category merchant banker as key member of its valuation team and served numerous clients across various industries including auto, e-commerce, EPC companies, insurance, financial institutions, hotels, healthcare, public, private sector banks, and many other corporates, and provided valuation opinion for diverse purposes, including strategic business purpose, restructuring, financial reporting, tax purpose, issue of shares, transfer of shares, preferential allotment, ESOPs, sweat equity. He also has experience in doing valuation of complex financial instruments and intangible assets valuation. He has also acted as expert valuer in many insolvency proceedings under Insolvency and Bankruptcy Code 2016 and financial reporting of the company, securities and financial assets. He has co-authored various articles and books on valuations. So this was the brief profile of Mr. Sameer Verma. Sir, we welcome you. Very good morning, sir.
So good morning, all of you. So since Jivika ji has been told much of me, I am not been of that much introductory call. So thank you so much for the opportunity today. So I am being here to discuss some of the challenges we being an valuer been facing while doing valuation specifically for the pre-revenue startup companies. So I start by a point. What if a subject company knows what a valuer is going to give a valuation before we as a valuer? So actually we are been doing a fair valuation or we are been calculating a value. So if you go, when we buy or sell anything in the market, that is being the price. So the transaction happening in the market is take place at a price. For the same valuation, two valuers may reach at the correct valuation. Why it is so? Because the transaction price as a valuer is already known to us. What is been actually the differentiating factor between two valuers? It is only the process and the documentation they are been making. Valuation is always been the tug of war between the process a valuer is been following, one valuer is following, and the drivers between what valuation subject company is been driving a value for the factors. Like one company may be belonging to a sector which is being so booming, the management team is being so competitive, the competition in which the company is having, the scalability model the company is having. We know that the two companies with the same top line and the bottom line may not get the same business valuation. We also know that the company with products in the pipeline, say, and the or the testing phase strongly depended upon the discounted cash flow methodology, which comes under the income approach. If we look at the financial projections of these kind of a companies, been a factor of uncertainty, because it has been a very difficult to estimate the impact of the revenue levels. So usually every valuation has been starting at the looking at the historical trend, and then we could go by estimating the future possibility they could be making. This is being the biggest challenge for the startup companies, as we do not have much of the historical trend, and further the business of the startup company is likely to project the losses in the initial phase. So I am been talking about the valuation process. The understanding of the assignment or the signing of a letter of engagement is been the very basic concept, but the point 3, 4, and 5, that is been the data collection, review of documents, or research as per the company industry or economic analysis framework, and the valuation analysis. These 3, 4, 5 points make one valuer different from the another valuer. Otherwise, rest of the processes, each or all of us as an valuer been following. These 3, 4, 5 points make one valuer from the another.
1 minute, Mr. Sameer. I request the host to make the speaker as co-host so that he can launch the poll. Okay, Sameer, continue.
Okay. So if we look at the valuation of the business cycle, it always follow the law of economics. Like a company which is at the startup phase and the company which is at the declining phase cannot be valued considering the same valuation methodologies. Like the company which has been at the very early stage is been more dependent upon the business model of the company, and which is being called as a future financial model and the qualitative aspects. Or as the company moves from the startup to the mature phase, the valuation will be more dependent upon the business model plus the assets of the company. As the company moves from the maturity stage to the declining phase, the valuation will be more dependent upon the assets of the company. Like we being the registered valuer do the valuation for the IBC companies into the IBC. So the valuation is being much more dependent upon the assets of the company. Fundamentally, if we talk about the valuation of the startups, is been very difficult to estimate in comparison to the valuation of the established company. When we look at the valuation of any company, we generally evaluate the assets. So what all are the assets in the balance sheet of the company? If we talk about the startup companies which has not been making revenue, the assets in the balance sheet of the company may be in the form of the intangibles. That could be any disrupted idea or not, or supported by any kind of a technological platform. So let's roll up our sleeves and start with the fundamental valuation approaches, which generally been followed in valuation of any company. These approaches, like, and always we do valuation of any company, we always come across the three approaches. One is the asset approach, which some persons call it as a cost approach. Second one is the market approach, and third one is the income approach. Rest all other methodologies I have been segregated and mentioned under the other valuation methodologies. So out of these three approaches, I am been specifically taking care of the asset approach, market approach, and income approach. Asset approach and income approach drives the fundamental value of any company. Market approach drives the relative value of the company, because we are been driving the value in comparison with the listed companies. Each approach has its own relevance that vary from industry to industry. Like asset approach has its importance when we are been undertaking the value of the real estate companies, which is having the bulk land in their balance sheet. Likely income approach has a predominant role when we are been valuing a service industry. So specific methodologies which come in under the income approach is been a discounted cash flow. That is also the biggest weapon in the hands of any valuer while applying the discounted cash flow is the alpha while driving the cost of equity or any kind of a discounting factor, which this alpha factor is also known as the company specific risk premium. So when I have been discussed many valuer, I have been under discussion with many company persons. So they have a viewpoint why we are been going by applying the any other methodology. If you are been finding the projections of any company or you have to arrive at the any transaction price, you just tweak this alpha factor or company specific risk premium to normalize the projection or to reach as the transaction price. If we in general or talk about this company specific risk premium, the company specific risk premium is been dependent upon these 6 factors which we into the valuation practice look at, that these 6 factors are been the projections may be aggressive or some qualified opinion has been made by the auditor in the annual report of the company. The business model of the company is unfavorable, which a valuer has been talking about. The customer concentration risk has been there. The company has been projecting to earn a revenue maybe from the single or 2 customers. What if that customer switch off to another company? The liquidity and solvency risk has been there. This makes us important to evaluate the ratio analysis of the specific subject company. The industry may be the negative or geography forecast need to be worked it on. Last approach, that is the market approach. It has a predominant role when we are been comparing it, our subject company with the listed peer companies. So when we are talking about the selection of a peer company, we need to be ensured that we are being found the closest industry, and if possible, if we can be able to narrow down the selected industry as per the customer segmentation, that will help us to remove the inaccuracies as well. Further, there have been few factors which need to be taken care while doing valuation of any company. We are not being specific to the pre-revenue stage company. If that been of any company belongs to any sector, we must evaluate the promoter's background, the nature of the business, economic outlook in general, past history and the trend which is not been there in case of a startup pre-revenue stage, future potential of any business, contingent liability, and of course the company which has been established, the corporate governance factor has been there. The more boxes has been checked, the more better prospects to arrive at the fair value of the company. So these are been the basic methodologies I have mentioned under every approach we usually applied. So now the NAV methodology, which comes under the asset approach, if we simply take it as what is been coming as a shareholders fund in the balance sheet of the company, it takes us to arrive at the minority value. Now, if we take the fair value of all the assets of the company in the balance sheet of the company, that will provide us to reach at the control value. Likely, if we move on to the comparable companies methodology under the market approach, if we are applying the private to this specific methodology, provide us the minority value of the company because all the multiples are been driving from the market, which has been getting trading by the retail investors. Likely, if we apply the discounted cash flow under the income approach, this methodology provides us the control value of the company. So the valuation methodologies are been totally dependent upon the purpose and the kind of a value we want to arrive at. So likely we are been talking about the valuation for the startups. There are been some methodologies which we can apply besides these methodologies. Like there are been all these methodologies. As per me, I can segregate these methodologies into three subsegments, like Burkus method, scorecard, and risk summation methods can be subsegmented into one category as per the qualitative aspect. Likely venture capitalist and first Chicago method can be subsegment into one category based upon the quantitative aspect, because these two methods are been quantifying the quantitative factors of the subject company and can be used only if the independent round of investment has not been taken place in the subject company. Backsolve method is being used only if the independent round of investment has been taken place in your subject company, because this methodology is specifically being used to take out the value of a preferred right of the is because there have been many kind of investors who ask for the preference right or liquidation right while making investment in your startup company. So this specific methodology, backsolve methodology, is being used to take out the value of those preferred rights in comparison to the value of equity shareholder. So there have been I have mentioned specific rule of thumb which can be used in valuing the specific industry, like hospital. The enterprise value by the room as a rule of thumb can be used. For the oil factor, it is been the EV by the barrel of can be used. For the power sector, it is been a megawatt sector point can be used. For the banks, the non-performing assets are been there. But as per me, these rule of thumb is been not recommended to use, because it may not give the fair value for in comparison to your startup company. So these are the methodologies which I have been in general mentioning over here for the valuation of an intangible, because I have earlier mentioned that the major assets in the balance sheet of your startup company may be in the form of the intangibles. That maybe I have earlier mentioned that maybe disrupted idea or the technological platform. So I feel good to mention the basic approaches we generally use, or the methodology we generally use for valuation of an intangible point. So I may take some time to mention over here, if we have been doing a valuation of, suppose, an auto dealership company. So I'm not take your mind to the valuation of a client company has approached you and it is been running a business model of auto dealership. So it is been make important for us to segregate the revenue points where it is been making. As per me, the auto dealership company has been making revenue from the three subsegments: by selling a new cars, by selling some old cars and parts. Besides these tangible assets, there is an intangible asset in the form of the customer contracts they've been having, or brand, or the size of an area. So these kind of intangibles require to be value based upon the maybe called as an income approach, which can be a customer relationship you have with and without method, which is being used to value the technological impact. So if someone been asked me to value that specific technology, my first point to that person is been what kind of a revenue level you are been generating with this technology. What if this technology would not be there in your business? So segregating the two kind of a projection levels by using the technological, that can help me to understand the value of that particular technological platform. Risk relief from the royalty method, which is being generally used to value the trademark and the brand name. Likely the option pricing model is being used to value the technological that has a potential to generate the income in the future, which is not been there in the balance sheet of the company right now, but it has a potential to generate the future income. Some of the factors I have mentioned here while doing the valuation of there are maybe some trade receivables are being there, or the unbilled revenue. So the factors which we can evaluate to take out the fair value of the trade receivables are the aging, percentage of projects, subsequent billing or revenue, recovery are being there. Likely for the service concession agreements, the company has been incorporated. It is not generating the revenue, but there it has been able to been able to take the service concession agreements with the from any kind of a vendor. So the valuation has been totally dependent upon the discounted cash flow methodology. I agree, but the factors which we need to evaluate and not to rely only on the numbers, we need to take out the cash flow during the tenure of the project. What exactly been the termination clauses are been there? What are all are the risk involved is been there? Future liability for the company, terms of outsourcing. Likely for the investment and loans, we need to work it. There are been many companies which have been incorporated not to generate revenue, but to make in further investments. So we have to not to look at the only the balance sheet of the company. We need to look at the fair value of all those investments, step down investment companies, which may be unlisted or listed. If they are been listed one, we have to rely upon the market price of the companies. If they are been frequently traded, or otherwise do the valuation from by applying other methodologies. Likely cash and bank balance need to be reconciled. We should not be rely on the bank balance, or the bank balance has been coming in the balance sheet of the company as on the date of valuation. Suppose a company has made investment in the mutual funds, we need to undertake the fair value of all those mutual funds based upon the NAV as on date of valuation. As per me, up till now, what we have been discussed, the business aspects add a value to the company if and only if it decrease the implied risk, that alpha factor which we have discussed in under the income approach, discounted cash flow methodology, or alternatively, company has increased its cash flow. The way to calculate the overall value is taken into account and dependent upon the many factors. Like if a startup company approach me, which has not been generated any revenue up till now, so how I can evaluate or make it out these projections are been realistic in nature or not. So first factor which we can evaluate is the churn rate. We need to ensure that suppose your client company has a subscription based model. So you being an evaluator should be very concerned how long these client company is been projecting to keep its customer. That can be evaluated basically with the churn rate of the subject company. Like different companies into the different industry has the different churn rate. Like if we talk about the today's scenario where the customer is been very much attracted towards the online business model, where the OTT video streaming over the top platforms like the Netflix, Amazon Prime, and the Hotstar business model is been catching a lots of eye factors. It becomes the cynosure of all eyes. The churn rate of these kind of companies is always been the more than the media and entertainment companies. Business model of your client company, is it a B2B or B2C? B2C companies churn rate is always higher than the B2B companies. All these factors can help you to evaluate the financial projections of your client companies, whether all those financial projections are on the realistic stage or not. If you can evaluate the gross margin with the capex factor, you can evaluate the projected marketing cost being projected by your client company, and with the new signups they are been looking at. One major factor which generally we evaluate is the revenue per employee. Some companies project the revenue, but in comparison, the number of employees are not been that much. So if you want to check whether your personnel forecast is been on the realistic ground or not, you can divide the total projected revenue by your client company by the number of employees in that particular year. This will tell you how much revenue your client company is been expected to generate per employee, and provides you the solid base to in comparison with your competitors and the industry leader. So I have taken out just a minute. I have taken out the revenue per employee of top 20 companies in the market. This data has been taken out from the how much database. So if you look at the Yahoo per employee per employee revenue rate is $608,000 USD dollars. And likely your client company has been expected to generate likely business model, though Yahoo is been established in the market, but still it is been expected to generate a $900,000. So those projections are cannot be said that has been made on a realistic ground. We need to look at all these factors before applying any other kind of a methodology. Many of my valuers, supporting valuers, is been saying that the valuation of a startup company has been largely dependent upon the discounted cash flow methodology. Totally agree with all those persons, but we as an valuer been um, dependent upon are been responsible to make the due diligence of those kind of financials which are making the base for the discounted cash flow methodology. We need to evaluate the valuation and the traction metrics. So if you look at the valuation, all the companies have at the stage of the startups are been at a different stages, like whether they are been at the ideation stage or they are been at the mock-up stage. They have developed a MVP product, or their product is been at a unpaid pilot stage, or is it is being at the stage of generating the revenue. So the earliest the stages of any startups there where there be no revenue, no assets, no team, no business, just an idea or willingness to move forward. At this point, the qualitative methods help you to look at the valuation of any company, not only the discounted cash flow methodology. Idea is having the value, but only looking at the valuation of an idea from the quantitative aspects may take you to a unreasonable ground. So we need to evaluate the traction. If we evaluate any company, every the company is having the three phases of development: idea to product, from product to traction, or from traction to scales. Suppose a person with a mindset of a Jeff Bezos come up with an suppose the Jeff Bezos come up with an idea. So the value you cannot be questioning on the what kind of an idea the person is taking out, though the person has already been built up his reputation in the market, where revenue has been in the nature of B2B or B2C. Like we have been discussed, the B2C business model is having a churn rate more than the B2B business model. The distribution challenge has been built up by the startup companies. If a startup company has been in nature of e-commerce, sector growth has been there or not, how many number of active users you have, or how many been registered users you are been projecting in the coming years, partnership or clients you have achieved or not, how many amount of traffics you have generated up till now, or how many amount of traffic you are been expecting to generate in the near future. Further, besides all these factors, there are been some another factors which can help us to justify a solid ground for our value, like in a regulatory aspects. If we talk about the fantasy gaming as of now, the fantasy gaming always is getting a challenge of GST aspects and the payment gateway issues. So are being your company is been solid to tackle all these issues or not? Like in a being in a valuer, we can evaluate the payback period to any investor. So investor generally have a mindset to take an exit within next 5 years or 6 years, and your company has been talking about to give a payback of next 10 to 12 years. We need to evaluate that point as well. Need to look at the long-term projection for companies which are been not turning to be into profit or otherwise. As per us, the forward 3 years projection for these kind of companies are ample. I have taken out some of the emerging industries which have already been established, the startups which have proved themselves to be and become the unicorns in this specific area. So a company which is been developing a business model in the specific industry, say financial services, and been into the sector of peer-to-peer lending. So this that particular sub industry has been providing us a reasonable ground to evaluate whether that particular business model is acceptable to market earlier or not. If that has not been accepted to market, we should not be look at the financial numbers of the companies per se. We have to evaluate the qualitative aspects of which will help us to give normalize the projections of the company. So the financial methodologies which I have earlier mentioned for the startups, and I have been able to segregate or these methodology into three subsegments, like in a Burkus method, scorecard, and risk summation methodology. So I am been taking developed a case study for you all that help you to understand these methodology in a better manner. Give me a minute. So the transaction which I have mentioned over here, the date of valuation is of 31st of March 2020. The company X has not been generated a revenue and is been currently operating into loss because of the business development expenses the company has made up till now. The company has the skilled co-founders, and the company has made an capex of 1 crore INR and moved an inch little from the ideation stage and converting the idea into the commercial service and projecting to make the revenue within a span of next 3 years. So we have to evaluate the value of this specific company, which is been under the development phase and seeking to raise the fund of USD 1 million. So we have applied a methodology called First Chicago. I have told you that all the methodologies which startups valuation of startups can be used can be segregated into three subsegments. So thus quantitative value through the First Chicago is being generally a combination of discounted cash flow and a comparable companies methodology. So it is been a mixed breed, you can say. We need to segregate the projections made by the company into three scenarios, like a success, survival, and failure. Generally, we ask these three scenarios projections from the client itself. If client would not be able to provide us the projections in these three scenarios, what we do as per the client business model of its company is always on the success level. So we divide the projections into three scenarios by taking the 65% of the company's projections, what it is been projecting at the success level to survival level, and rest 40% at the failure level. Now, nowhere had been written these percentages as per us. We divided in that particular, nowhere it has been mentioned that we need to divide that to 65% into the survival level, and company can be able to survive only if the 65% it can meet, and the 40% into the failures. But still, these kind of a percentages help us to reach at a reasonable kind of a value. The company EBITDA is been coming, it is been 127.95 million is been projected by the company. We have taken the same margin of the company based upon the revenue. We have been projected as 65%. The discounting factor has been established considering the additional alpha factor, which we have discussed earlier before. Since the company has been projecting to be into the generating the EBITDA 127 EBITDA after 3 years from now, so discounting factor has been calculated accordingly, because that number of 127.95 is not as of now. It is been after 3 years from the date of valuation. So the present value factor has been calculated the 3 years forward. The adjusted accordingly, the EV by EBITDA multiple of the closest industry has been taken out. likely I have been talked about the if it has been possible for you to narrow down the closest industry as per the customer segmentation point. But if not, you can be take the point of the industry. EV by beta as for the specific case has been taken out for the 4 times of, and accordingly we have reached up the value of operation to 195.40. We have added back the cash the company is having into its balance sheet as on date of valuation. We reach to the enterprise value, and likely we have subtracted the debt as on date of valuation. We reach to the concluded equity value, that is been the post money. Since the company has been projecting to and been raising a round of funding to take like I have been mentioned over here, the company has been seeking a fund of $1 million. That amount I have deducted from the company calculated post money value, because these projections are being dependent upon the availability of this fund. So this specific value is been dependent upon the availability of this fund. So I have deducted this capex amount of 75 million from the concluded equity value and reached to a pre-money value of 10 crores. Now specific 10 crores value cannot, that is being totally dependent upon the quantitative aspect. Now if we evaluate the qualitative aspect of this company, there are been specific factors, qualitative factors, which I have mentioned, that the size of opportunity, product technology uniqueness, operational stage of the startup, is it as the ideation stage, concepting stage, validation stage, scaling stage, or establishing stage, how long the core company team is been together, because the co-founder role in any startup is been playing a major role. Traction of the any startup has been there, competitive environment, additional investment they are been seeking for after this specific round of investment, what alternative do the customer is having right now. So I have mentioned the some percentage of all these factors, and as per me, after evaluating the industry or the Google searches, what I am been and giving us me the confidence, I have been able to reach some kind of factors. So if we evaluate or Google out the scorecard methodology, so if a company is been scoring 100%, that is been called as a better than average. If it is been scoring only 100%, that is scoring over and above to 100%, that is been called as a better than average. If it is scoring 100%, that is an average company, or it is scoring less than 100%, that is called as a worse than average. All these percentages has been sum up, and as per me, the 10 crores value which has been computed through the first Chicago method should be given a value of 3 crores, that is been into INR. So the computed value, so what if we apply directly the discounted cash flow on these projections, the value could be come up to the 50 crores. But as per me, the moment I have applied the scenario based valuation and the qualitative factors, the value of this company as per me should be around to 3 crores. So there has been a huge gap between these two factors. There are been many buddy registered valuers of mine who has been strongly focused upon to apply the discounted cash flow methodology for valuation of any company. But as per me, the application of the discounted cash flow methodology without evaluating the supporting financial numbers may give us a value that it is not a realistic one. Likely I have tried to apply the venture capitalist model. So the venture capitalist model is been which is been telling us how if an investor is been expecting to generate a return of say 40%, so what should be the value of the company that gives us the investor a return of expected return of the investor. In the specific case, the investor is expected to take the exit in 2026. The company has been projecting the revenue in 2026 year is been 258 million and EBITDA of 153. So industry, what we are been industry multiple taken out as the 4 times. So the enterprise value in 2026 taken out as an 613. The cash as per the exit year is 185. That comes out the enterprise value in 2026. Debt at the exit year, company is projecting as than 20 million. So
Mr. Sameer, sorry to interrupt you. You can be a little slow also because these are case studies, no? So
yeah,
people will have to little bit slow. You can go. Some requests have come from the participants.
Shall I start it from the beginning?
No, this one only.
No.
Little bit slow.
Okay, sure.
And a few questions are coming in the chat box related to the presentation which you are making, Sameer. So if you can have a look at that, or if you want us to raise those questions to you also, we can do that. It depends upon how much time you have.
I try to solve as soon as possible. So just give me 5 to 10 minutes. I'm been through my presentation.
Okay, you'll take the questions after you complete the presentation?
Yeah, I take
okay.
that.
Okay, thank you.
Thank you. So a venture capitalist model is been more focused upon the when investor is been focusing towards the taken exit from the company. Like in the particular year case, the company is been investor is been asking to take an exit in 6 years from now. In 2026, the investor is been asking to take an exit. So the revenue which a sub-client company is been projected after 6 years is 258 million. And the likely EBITDA for 153 million after 6 years from now. EV by EBITDA multiple, which I'm been able to taken out is 4 times as on date. So the value of operations for the 2026 at the year in which the investor is been asking an exit is 613 million. The cash which company is been mentioned taken out and in that particular year exit year is 185 million. The enterprise value taken out computed to be 79 crores. The debt is been 2 crores. I have deducted that debt part in from the enterprise value. I reached to the equity value of 77 crores. Total capex till that period from the date of valuation, that is 31st of March 2020 to 31st of March 2026, the company required the capex of 56 crore rupees. So because these projections are totally been dependent upon the availability of this amount of debt. So the moment I deduct this amount from the equity value which I have computed for 2026, I reach to the equity value, adjusted equity value for of the company of 21 crores. Now the specific investor is been asking a return of 40%. So the 40% and present value factor for next 6 years reach to an 0.13. जो 40% का वैल्यू फैक्टर है वो आज से 6 साल के बाद अगर हम देखेंगे तो वो 1.13 कंप्यूट होगा. तो 0.13 के बेसिस पे if we multiply that 211 by 0.13 we reach to an equity value as on date of 28 million. So what we have been computing through scorecard methodology, the value is from through scorecard methodology is 3 crores, and that is with the venture capitalist I am reaching at a value of 2.8 crores. That is being a close by value. When an investor is being expected return of the investor is 40%. So as
why you're not taking an impact of working capital in this? You only take a capex requirement.
So yeah, I have told you, Nana, venture capitalist model is been a bridge model, which because I am been doing a calculation through the EV by EBITDA multiple. That is being comparable companies. I'm not doing the discounted cash flow, na.
Okay.
This is been totally dependent upon the comparable companies methodology. The EBITDA of the company in 2026 is been getting multiplied with the comparable companies multiple as on date.
There are also questions on this particular slide, Mr. Sameer, on the chat.
Yeah, I am not been able to just hold on.
Sameer, just continuing with the same question, even when we do EV EBITDA multiple, we don't reduce capex. Now we just make adjustments for the cash and debt to the enterprise value what we get
Totally
while doing a comparison. Yeah,
Totally
but
agree
why
with
in
you.
this specific case capex we have reduced?
Yeah, please.
I'm not very clear on that. If you can
Yeah,
just elaborate.
because sir, the company EBITDA factor as on 2026 is dependent upon the investment of the to the company during that tenure. Na? If the company is not able to procure that capex amount or the future investment, how the company can be able to generate that much amount of EBITDA?
So normally for venture capital method, we see this method as a kind of some sort of modification in the market multiple or trading multiple, right? So in normally EV EBITDA multiple, we don't use the
Yeah,
capex or
I have specifically applied this multiple. If you are being able to, yeah, your client company is been projecting up to be into profit, and you can be able to find out the PE multiple of your company. You can directly apply that PE multiple. Need not to make an adjustment for the debt and cash in that case. That multiple application is been dependent upon the valuer choice. It has nowhere been mentioned that you have to apply specific to EV by EBITDA multiple only. We know that the EBITDA multiple is been of a higher choice in the companies having the debt portion in their capital structure. So I prefer to apply the EV by EBITDA multiple in the companies where there is a portion of a debt in their capital structure. If a company has been 100% equity financed and projecting not to take any kind of a debt portion, so I prefer to go by the PE multiple. Since my client company has been projecting to take a facility of the debt as well, so I prefer to go by the EV by EBITDA multiple. If you applied the PE multiple in your subject client company, then you directly reach to the equity value of the company. But still, the capex, then the future value is been required to deduct, because this value, whatsoever the amount you are being investor is been giving right now, is being having some value after the period of 6 years.
Sameer, my question is little otherwise. So basically, just want to point out, if you look into EBITDA multiple, what we have considered is of, I believe, is of a quite low growth companies, and the discount rate which we have considered is for high growth and risky companies, and for which venture capital has invested. So if you look into if the 40% kind of a growth which are expected out of a company, the EBITDA multiple can't be so low. Overall, what this has been, I understand we can take any multiple, either it could be revenue or EBITDA based on the size of the size and stage and other things. However, reference to growth has to be given. I am not sure, the reference to growth has been after reference to growth, 4 multiple seems on little lower side, which is reducing the overall valuation. 40% चाहिए तो 4 का multiple तो बहुत ही कम है.
No, that's okay. That's okay. But the company which has been not generated any revenue as on date, that totally been dependent upon the selection of comparables, sir. This multiple is been totally dependent upon the selection of comparables and the availability of comparables. So there are been many times the company which has been established, or the company which has been recently trying to generate a revenue, may not be able to find that. Suppose if you have been doing an evaluation for the e-commerce company, e-commerce business model, from in which industry we take that particular e-commerce business model into the industry, we could not be able to find any kind of a listed company. Because
we can get transaction.
So sir, when we are not being able to find exact comparables now, we generally move out to outside India, foreign land. And foreign land,
lot of transaction, we can got a lot of transactions. So a lot of funding transactions, we could rely those, and use CTM. So
definitely do that, sir. We can definitely can do that. But at the end, there has been a limitation of the information. The comparable transaction multiple can only be applied if we have handy with all the information with respect to that particular transaction. if you are been handy with all the information with respect to the comparable transactions, now nothing better than that, sir.
Can I, since I think we are very close to the end of the slide presentation, let me pose a few questions, and I'll ask Joy Jain. There's Joy Jain, and then there's Venkata Gangadhar Nekanti, who's both of these are highly experienced valuers. So Joy's questions, I'll just mention Joy's question to you, the first one, and after that I'll request Joy to speak in case required. So he's asking a question in the case of the case study first Chicago method. Why would the discount rate increase in case of failure? The risk is already factored into revenue by projecting lower sales. He's saying there's a bit of double counting there. What do you think of that, Sameer?
Sir, that is been this factor, this is being projected by the company. The financial number is being projected by the company. You as per my buddy registered value is been talking about the 65% has already been taken off. But as for the convenience side, 1% additional we usually give as an additional alpha factor in this specific case, because this factor is been our tweaky one. We need to undoubtedly why 65% we should take the 70%, or why not the 60%. This has been largely been a subjective in nature and depends upon the valuer call. But as an valuer, we try to be on a conservative side. So we usually give the 1% additional to the survival level and the 2% additional in case of a failure.
No, shouldn't be the other way around, because higher the revenue, higher the projected revenue, higher the risk.
The risk?
The risk will be higher of not achieving the revenues. Now, if the projected revenue is higher, say in the case of success, then shouldn't the discount rate be higher in that case? I'm saying absolutely the opposite of what you're saying.
Okay.
So I am saying that 22.26% should have been in the case of success, and 20.26% should have been in the case of failure.
But sir, in this specific case, I totally agree with your point, sir. I totally agree with your point. You have been saying that if a company is making success, it should be discounted by 22.26%.
Yeah, because the the possibility or probability of making that revenue, the risk is higher, because you're already projecting a more aggressive revenue.
Yeah, I totally agree with your point. That should be ideally taken care of. But as what we have been carried out, I have been discussing with you. Altogether, your point, I buy with your point that if a company has been making us revenue of or projecting a revenue of 199 million, we should be discount that particular point with a higher discount rate. I buy with your point, sir.
So just to add here, when we have considered three scenarios and the probability for three scenarios, then what would happen is from uncertain cash flows, they would become certain cash flows.
Correct.
And when we are looking at risk, it is not just the upside risk, but also the downside risk, which we are taking into consideration. So if in the case of failure, we are considering a particular cash flow, then although the upside risk could have been reduced, there will always be a downside risk. So lesser the cash flows does not necessarily mean lesser the risk. So that being the case, when we have three probabilities, in my humble opinion, we should consider the same discount factor, is what I was thinking.
Sir, this has been the general scenario which has been acceptable in the market. However, I buy the point which sir has been mentioned over here, that the success factor should be discounted by the higher discount rate instead with the failure one. I buy that point, but since the value which I have been projected over here and given the 65% failure survival to the success point, I have decided to give additional 1% to that survivor point and 2% in case of a failure, because I have already been very aggressive while computing that percentage of 40% in case of a failure one.
Agreed, sir. The thing is, what would happen is, if in the case of failure, we have considered a particular cash flow, and if the company actually achieves better cash flows, then there is also a risk. The thing is, when we are talking about risk, we should not only consider the upside risk, downside risk, but also we should consider the upside risk. And both of them have been considered while making the project, while making three particular scenarios. That being the case, the discount factor which we should take should be the same for all the three scenarios, is what I feel.
You are been trying to say that when we have taken the or substantiate the projections on the top level side, we should not take the additional alpha factor in case of survival or failure. We should discount it at the same discount rate.
Perfectly right, sir.
So that's been totally a value or choice, sir. Nowhere has been mentioned about that. Since this factor has been very subjective in nature, you can take the same discount rate. Nowhere has been mentioned.
Perfect, sir.
Nowhere has been mentioned why not being with the same discount rate and why with the additional alpha factor of 1% or 2%. You can do that if you are been striking your mind or getting satisfied with the projections of the companies on the conservative side. You can do that or discount the same projections with a same discounting factor. In my case, the EBITDA margin of the company is on a very higher side, like in a 50 to 55%. So I feel good to discount these kind of projections, since I am not been making a cut in the EBITDA margin. I am been just taking the same EBITDA margin in case of a survival and failure. So I presume it good to take an additional discount in case of a survival and failure. I'm just making a cut in case of a top line sales, 65% in case of a sales and 40% in case of a failure, not the EBITDA margin of the company. So I feel good to take an additional discounting factor in case of a survival and failure.
Perfect, sir. I think we can move on. Perfect, sir. Thanks a lot.
Mr. Sameer, I would request you to complete the presentation and launch the polls also, because the Q&A session also will be joining, starting after this.
I do that.
Right. And what I will suggest, Sameer, is that you stay on so that some of these questions we can answer in the panel itself together with the other valuers. Okay.
Undoubtedly, I'm being here, sir. So that these are some of the points I have been mentioned that like my buddy Failures has mentioned that what can be we follow the approach to be on the very realistic insight. So some points I've been mentioned over there, that Sam Dam Spast Kam Sakarta and Pabanda. We should follow these kind of core values in our profession to be a very I'm sure that we are you all are been following right now also in your professional life. But still, as per my little experience, I mean mentioned over there that if we follow these kind of values and principles, undoubtedly we can keep our profession alive. So that is what I have with me. I am just raising some poll questions for you all for clarity or what we have been discussed as of now. So this is what I have been raised of question number 1. So identify the formula for the customer churn rate. I believe you are being able to see these 4.
Yes, we can see it.
I request all the participants to participate in the poll, because this poll report will be submitted to IBBI. Accordingly, they will consider your attendance.
Sameer, I think you can close the poll.
Sure, sure. So the number one option, that is the number of customers lost in the potential or the total customer base, has been the right one. I'm raising the poll number 2 for you all. Undoubtedly, the discounted cash flow gives us the control value. Where majority of us have been right, we will reach at the change in net cash working capital.
I request all the participants to quickly answer the poll considering the paucity of time. It's a request, please.
Yes, my all the buddy valuers are been right that the depreciation is been non-cash charge, which is been added back to reach at the free cash flow. No, the company which is been at the maturity stage are been established, already been established. So the profit margin, the bottom line of these companies are been established one, that is not been required any kind of a further adjustments. So the price to sales multiple is always been preferable for the companies at the startup phase.
What is the meaning of price in this, Mr. Sameer? Price meaning?
Is the equity value, market cap to sales. You can also been refer to these kind of a multiple. That is been when you multiply the comparable companies multiple of sales multiple with the sales of the subject company, you will reach at the equity value of the company. That is been referred to as the market cap for the listed one. Price is the equity value over here.
Okay.
So the answer is maturity, is it?
No, it is been startup phase.
Okay.
Undoubtedly, the companies in the internet space are being totally dependent upon the growth opportunities they have been having. The companies who's not been earning any kind of who's not been having any kind of earning is strongly been dependent upon the book value multiple. I believe this one is the favorite one for all. Undoubtedly, this has been called as a common equity or shareholders fund and net worth. So thank you so much all for increasing my learning or sharing your views and suggestions.
Now we are going to start the panel question answer session. All the panelists have joined. Mr. Abraham Matthew shall moderate the session. I request Jivika to introduce all the panelists. The official vote of thanks for the session will be given in the end, Mr. Sameer.
Thank you so much.
Please be in the session.
Yeah.
Once again, it's my privilege to introduce the panelists for today's panel discussion. So our first panelist is Mr. Arun Ratnam. Arun Ratnam is a director with valuations and business modeling practice in EY India. He joined EY in 2014. His prior experience includes a stint with Deloitte Valuations Group for 7 years. Arun is an MBA from Bharti Dasan University, Trichy, and a computer science engineer from Madras University. Arun has over 15 years of experience providing valuation advisory services to clients across industries, especially life sciences, pharma, and IT industry, amongst other valuation engagements. We welcome you, sir. Next on our panel is Mr. Manish Saxena. Mr. Manish is a partner with the valuation services practice of Grant Thornton, India. He has over 15 years of experience in the area of valuation, research, and corporate finance. Manish has been involved in offering valuation consulting services for some of the large and reputed Indian companies in various sectors, including IT, healthcare, manufacturing, financial services, etc. His prior work experience also includes stints with Thomas Wiesel Partners, Deloitte Financial Advisory Services, and GE Capital International Services. Manish is an MBA from MDI Gurgaon and a Bachelor of Engineering Mechanical. He is also a CFA and FRM, registered valuer with IBBI. He has authored various articles on valuation, including ERP study for Indian market, a comparative analysis of different variants of discounted cash flow methodology, inaugural issue by the Valuation Standards Board ICAI, control premium study in India, etc. We welcome you, Mr. Manish.
Thank you.
Next on our panel is Mr. Darshan Rathor. Darshan Rathor is the co-founder partner at Acumen M&A Advisors, India, specializing in M&A and business advisory. He also co-heads the business for Woodbridge International, a Connecticut-based M&A advisory firm, and is the President Strategy and Investor Relations at the BVG India. Following his father's footsteps, Darshan began his career as a chartered accountant. He is also a member of Chartered Alternate Investments Analysts, USA, and a registered valuer under the Companies Act in India. He has done his MBA in Finance and Strategy from Exeleri Jamshedpur, where he was awarded the O.P. Jindal Management Scholarship. He is currently a charter member at TIE Pune. Prior to Acumen, he has worked with EY, PwC, and Deutsche Bank Real Estate Private Equity. We welcome you, Mr. Rathor.
Thank you, Jivika.
Next on our panel is Mr. Manish Srivastav. Mr. Manish Srivastav is a fellow member of ICSI, registered valuer from IBBI Securities class, and an MBA Finance from IBS Hyderabad. Presently also pursuing PhD in Intangible Valuation. He is presently co-founder and director of Alpha Value Consulting Private Limited, which is a specialized valuation company. He possesses 15 years of experience in valuation domain and has worked with companies like PwC, NextGen Financial, Stockholding Corporation, PUG Securities, Citi Financials, etc., and corporate professionals. He, besides his corporate profile, has also spoken at various IIMs and Premier B School. He is also acting as mentor to Atal Incubation Cell, Startup Chopal, Marwari Catalyst. We welcome you, Mr. Manish.
Yeah, thank you, Jivika.
So this was the brief introduction of all our panelists. So over to you, Abraham, sir.
Thank you. I'll ask some of these questions in no particular order. I know that all of us have heard the speakers in one forum or the other, and we know how knowledgeable all of you are. We also know that many of our the people in the audience are experienced valuers, and I hope that they will also raise questions and participate if required. So the first one I'll address to Manish, because maybe you can take on from where Sameer was discussing. There were a few questions which were raised by Joy Jain, and maybe I'll just address it to you, Manish. See, the issue which we are seeing here, I'll just, in the VC method, for instance, Joy Jain is referring to the VC method. Just for your background, we had the situation where...
Mr. Abraham, just sorry to interrupt. We have two Manish Srivastava and Manish Saxena. So
Srivastava, I'm talking to Mr. Manish Srivastava first.
Okay.
Yes, sorry about that, Manish Saxena, in case that is... sorry. So here, interestingly, what Sameer did was that he used one method to arrive at an initial value, and then he used the next method to discount that value further. Okay, so here, this is an interesting concept because normally we as valuers use just one method, and then we corroborate that by using another method, whereas here he's using one in serial, one after the other. He's using two methods to discount the value further. What do you think about this approach, Manish Srivastava?
Sir, first of all, tell me briefly, like you're talking about like discounting the discounted free cash flow, and when we are using the comparable company method, because I have not heard of like what.
Okay, so what Sameer did for us is that he first took up, let's say, the scorecard method. Let's assume that's the method which he used. Sameer, you can just add on to this if. So first he used the scorecard method, and then he arrived at a certain value. And then that particular method, he used an alternative method to discount that value further. Okay, so this is where, how is this right?
So, actually he did the reverse. He first did First Chicago method, and then so the valuation that he got from First Chicago method, then he did the scorecard method and discounted it further based on the score. Based on the score.
Okay, I got it.
Mr. Sameer, can you share your screen for that screen if possible?
Yeah, I do that.
Yeah, you can share that particular screen so that the discussion everyone can recall.
I got the point. So let me deliberate on this. Like basically, when you are looking, it is not about like what sort of discount you are applying. Basically, you have to look into the company. Suppose it being into a very startup stage, and now you are looking into there being certain qualitative factors and there are certain quantitative factors. Okay, so now suppose the projection being provided by the management, and that you have applied the First Chicago method and looked into, okay, these are the three scenarios under which we are valuing the company. Okay, is that audible?
Yes.
So this basically First Chicago method, you are just applying the quantitative methodology and looking into like what is the value of the company. Okay, now the scenario is like every company is not the same. There may be company which have risen from the ideation stage and reached to a certain level. There may be company which have reached to at least A level of funding or B level of funding, and they're looking for the C level of funding. Okay, now we need to look into like what are the qualitative factors. Okay, so the First Chicago just talks about the quantitative aspect, but the scorecard method talks about certain qualitative factors. If the company has all the strength, all the factors that's in the scorecard, very positive side, then we will apply, we'll provide a grading, and we'll say that, okay, the number that they will getting is on a higher side. So this is something which you are adding the qualitative aspect to the quantitative value that you have derived for. Okay, so suppose the company has a patent, suppose the company has a strong founder, suppose the company being run by a person who has already taken exit in 3 of the companies very successfully, who has made the companies from day one, from the scratch, and taken it to a certain level. So he being an experienced person, now he is coming, then I will provide a greater weightage or the score to that sort of person. Okay, that may be the one part of it. So there may be a company which has a strong technology background. So this scorecard basically helps to create a fusion between the qualitative and the quantitative aspects of it.
So shouldn't that be factored into the alpha, which has already been considered in the first Chicago method?
I tell you, like the alpha is something that which you talk like additional risk premium, but the question is like when the company being the startup, the visibility is not being. You can't see the entire visibility like what is going to be, right? Just keep on adding more of the alpha and saying that I've been discounting at 30%. Okay, that may sometimes seems strange. So as well as the management will say, sir, I will be able to achieve it. Why you are applying so much of the discount to my particular cash flow? Okay, so in order to make him understand that it is not just discounting based on alpha, but they because of certain qualitative factors, I've been looking at discounting your company. Okay, so this will provide a better justification rather than just applying and adding 10%, 15% as an additional risk premium.
Because my understanding is that in the particular case study that was presented, the some alpha was already considered.
Some
alpha was already considered.
In alpha also, Joy mentioned, alpha also considered all these internal risks, right? Alpha also considers whatever that you have mentioned, these qualitative figures. Based on these qualitative figures scoring only, you will arrive alpha normally.
I got your point. The question is like, suppose you are taking an alpha and suppose my cost of equity is coming, suppose 15% as per CAPM method. And now I've been saying that adding 15% more and bringing the value, because I have to bring the value down. So it will something like the person will say that why you are applying 15% additional? What is the reason for that? Okay. So this is something like you can differentiate between the two startups, saying that, okay, because every time the startup comes, you have in mind like additional risk premium, I will apply 15%. But applying 15% blindly and saying that, okay, I'm reaching to a 30% level. So that this helps in bridging the combination between the two. I've been saying, suppose I've been applying 7.5% as an additional risk premium and then bringing the value based on the scorecard, because the management is not ready to accept like 30% as an additional risk premium, because he will talk about n number of things. I've been talking, I already have the order book, I have a discussion with the investor, next investor round is coming and all these things.
Manish, I have just one point to add. So basically the starting point in the scorecard method should not be, the valuation of a comparable companies. So basically what you have done is you have derived the value of the company first, and you have based on three scenarios and arrive at the value. So this is first of all, this is a discounted value, right? Which considers
I think
some amount of risk.
Can't hear you.
No. Is it better? Hello.
Carry on.
So we have considered some amount of risk already in first Chicago method. So don't you think so? Probably in scorecard method, the starting range should be valuation of a comparable companies, similar companies, instead of the value arrived through first Chicago method.
Basically, try to understand. Like suppose you as a valuer look into like this particular company, the value should be close to this particular range. Okay, the management is adamant. He is saying no, my projection will remain as such. And you are not convinced, suppose. Okay, then in that scenario, because you are not looking just at the projection provided by the management, you've been also looking at what is going to the visibility factor. Okay, now suppose my value is not reaching to the level what I've been expecting, as even after applying the first Chicago method. Okay, then that may be the scenario that I will apply the scorecard, and because I have to reach to the value which is a logical value. Okay, and this is not something which is like somewhere written or that is the methodology that need to be adopted. This is actually the valuer call that you need to build the value that being very justified value rather than the value something which is hyperbolic in nature. Okay, so it is the way and means like how you on a scientific basis you are applying your mind and bringing the value to the level which is justifiable in nature.
Okay. Ramesh, I think that answers your question, I hope. In which case, we will
You can
just
always
move on.
consider that in survival rate and success rate in the front.
Okay. So let me just move on. In the interest of time, let me just move to the next panelist. Let me just ask Manish Saxena, just to mentioning Saxena also, so that we are clear that speaking to the right Manish. So Manish, in your experience, we have outlined a number of methods. Basically, keep in mind that these are all pre-revenue companies which we are trying to value.
Right.
So is there a preference which we would have to a certain method? This is one part of the question. And the second is that how do you do the corroboration of whatever we have valued by using a more acceptable method, like say a DCF or so? What is the approach which you believe a valuer should take?
Okay, so first of all, I could not attend the entire session, so I don't know which approaches were covered. But I'll just talk about my
So let me
experience.
just briefly just briefly mention what Sameer had covered, and you're of course able. It's possible for you to speak about your own experience. That's good enough.
Right.
See, the methods which were covered were, let us say, the Berkus method is there. Then there's a first Chicago method. There's a scorecard method. So summation method. So these 6 methods are there, which he has outlined, which are the methodologies which we use alternatively to the approach, the 3 approaches which we have. Now, the question is that, so I've posed the question to you already. It's over to you, Manish.
Yeah. Sure. So, yeah, I can see the slide with the different approaches. Now, I mean, I'm aware of these approaches and the nomenclature which, we use for these approaches. But, from a practical perspective, what I'll say is that there are essentially 3 fundamental approaches. I mean, we all know those 3 fundamental approaches, which is cost, market, and income approach. Now, all these approaches which you would have gone through in the session are variants of these one of the 3 fundamental approaches, whether it's income approach, market approach, or cost approach. So essentially, while you can use these methods, as a backup for getting a comfort in the valuation that you're arriving for a particular startup, from a practical perspective, at least I personally have not applied these in my engagements with the client. So from a practical perspective, we typically use either an income approach, which is a DCF, or we use a market multiple approach, wherein we try to find any company which is comparable. And I understand there are challenges in terms of finding a comparable, particularly for startup, because even if you find a comparable, you will not have earnings, to apply on, or revenue will be very less. But still, we try to find some other benchmarks, like if it's an internet company or a consumer internet company, you can use user per user sort of multiple.
Carry on.
Yeah. So essentially, from a practical perspective, we always use DCF as a fallback option for a startup, and we corroborate that DCF value using a multiple method. And we can use some of these methods. Essentially, what these methods are doing is trying to benchmark your startup, on various parameters like scoring method or Berkus method or any other risk factor summation method. It is just trying to, it starts with a reference point. That reference point could be multiple of a comparable company. It could be just a, like in a scorecard method, you start with a fixed amount, which is the typical fund valuation of a early stage company, which could be 2 million or 3 million, and then you adjust it. So the starting point differs in these methods, but what you're essentially doing is you are comparing the subject startup company on various parameters in terms of management, risk profile, their market which they're serving, and then you're finally arriving at the final value. So as a valuer, because our reports, we also need to ensure that from a presentation perspective, if we use these method alone, it may not be robust from a regulator perspective. Whoever is the user of the report may not understand these approaches. So that is why from a presentation perspective, we still use a DCF method, and we corroborate that DCF value using either a market multiple approach or these method as a backup approach. So that's my bit on this point.
Yeah, that's the approach which I also take. But it's good to see that what you've said is
Manish, I have a question to add that. Do you follow a probabilistic scenario methods, or you stick to one kind of cash flows while valuing the startup?
Yeah, so if you ask my personal opinion, probability weighted method is a very good approach for valuing early stage company, because the challenge in a standard DCF is that you have to apply a very high alpha, right? In a single scenario to factor all the risk of the cash flows. You essentially have just one factor, which is the alpha. Now that becomes very subjective. And what the probability weighted approach does is it helps you see the risk in the cash flows more in a better way, right? Because you can see different scenarios, how those scenarios can pan out in the future. The worst scenario or the optimistic scenario, and that captures the risk better. That is my personal view. However, having said that, again, from a so presentation is different from what you feel is the right approach, because if the challenge in presenting a probability weighted scenario approach is that you are essentially taking the entire risk on you as a valuer. If you present 3 scenarios in the report, the management is not going to give you a representation on all the 3 scenarios, right? Management will say, this is the scenario I have given you. So in order to ensure that your risk is also manageable when you're issuing that report, I would still go with a management provided case. But I will still do a scenario based approach to assess the reasonableness of the alpha which I'm using in that one scenario report.
So since you have mentioned that you use alpha,
Right. Yeah.
is there any quantification method or any quantitative method to ascertain alpha? Or if you follow Jensen alpha method, you take portfolio, you compare portfolio ratings with market report. That may not be indicative alpha for a startup. So how do you calculate alpha without applying a random number? Is there any methodology to quantify the alpha?
Yeah, so see, essentially, if you look at the discount rate, it is made of 2 components. One is beta and one is alpha, right? Now, beta is your systemic risk. It measures the systemic risk in the company, which cannot be diversified away. Now, most of the time, we use beta by taking comparable companies, right?
Yes.
Now, if you look at the companies which you take as comparable, they are listed and big companies, whereas your value is a very early stage company. So essentially, you are already underestimating the beta of that company, of that startup, by comparing it with very large companies.
Yes.
So one of the way you can factor the risk for a startup valuation is identify companies which are early stage, so that you get the right beta. Or if you're not getting early stage companies, you can take, what we also sometimes do is take upper quartile of the beta, because there are various measures you can derive from a set of comparable companies. You can take upper end of the beta because your company has higher risk than the comparable company. So that is one way of factoring risk. But still, no matter what you do on the beta side, you will still have a scenario where you're not being able to factor all the risk, right? In that case, we break down the alpha into various components, right? So if you look at what the alpha represents, it comprises of various risks. The biggest risk which you have for a startup is the size risk compared to a large company. So a small company will always carry a higher risk, because it can be it is exposed to competition. There are various factors which can just wipe away that company. So there are studies which have quantified this size risk. So we also factor a size risk when we value a startup, right? Then there could be liquidity risks, and still then once you have quantified all these subcomponent of the alpha, you will still be left with the final alpha, right? So that we try to rationalize using, so that becomes a iterative process. What we do is we start with certain alpha which we feel is right. Now, how do we assess the reasonability of that? Then, so we first come to a value using a alpha which we believe is right. That value then we corroborate with multiple or other, these approaches can be handy in corroborating that value, right? If you feel that alpha is leading to a value which is not being, you're not able to corroborate with this method, you keep on increasing it, right? And then once that value is making sense from the different perspective, from the multiple perspective, from these methods perspective, then we say, okay, this alpha seems to be the right alpha for the company.
In multiple method also, the multiple that you apply is a comparable company, which is a listed company and compared to a larger size company.
Right.
Do you think that multiple also needs to be applied again? This you need to factor alpha there also. Do you think that it is an iterative process?
No, it's not iterative process in the sense that it one approach. See, it is iterative in the sense both are independent approach, right? Now I am looking at this company from different angles. One is the DCF approach, which is looking at what the company can generate in future. One is from the perspective of what is the valuation other similar companies have got, right? Now, if in the MM approach, I will apply the discount to the starting point, which could be the comparable company multiple independently. It will not be based on what I'm doing in the DCF analysis. It will be based on how I compare this company with a early stage, with a company which has already been transacted.
Okay. Basically, you follow CTM rather than CCM, right?
Yeah. Yeah, because you can approach, it depends on whatever you find as, see, CTM and CCM are both same. It is just that you're finding the comparable company, you're finding the value of a comparable company in a listed space or a transaction space. That's the only difference. But you're essentially comparing your subject company with those other comparable companies. And what I find these methods useful is in using this as a framework to compare my company with the other companies, on various parameters. The parameters you should compare your startup on compared to other companies can be derived from these methods, because it lays out those factors quite clearly, which is management quality, the size, the addressable market, the product quality, etc. And then you come up independently with on the value using the market approach and corroborate it with the value using the DCF approach.
Thank you.
Okay. Let me just pose a question to Arun Ratnam. So Arun, there are 2 or 3 questions actually which come up here. The first question is that based upon your experience, I'm assuming that you have valued pre-revenue startups, or you have done multiple valuations of the same company over a period of time. So the question is that when you have done a valuation of a startup or an early stage company, after a period of 5 years, have you been able to evaluate whether that valuation has stood up to the test of time? How has it stood up is the question. First question.
That's a very interesting question. Can you hear me first?
Yes.
Yeah, all right. I would ask my other panelists also to chip in here. But this question is very interesting because I'm reminded of what Professor Damodaran says. I'm not sure if you've read one of his blogs where he talks about valuing Amazon. His poster child for startup or early stage valuations used to be Amazon. And in one of his blogs, he's written that he had valued it like a few years back. And when he was valuing it as of a recent date, he realized that he had got everything terribly wrong. So if Professor Damodaran can get it wrong, I'm sure that we are all in the same bucket probably. So yeah, you're right. I mean, absolutely. We've also kind of gone. I can recall one specific example. There was this healthcare company based out of South India, and they had raised funds of almost. I mean, I think they were roughly valued at around 400 million. And we were asked to come in just at that point in time, and we were asked to value the company because there was a recent round of funding which happened at that time. We ended up, obviously, right, as valuers, we all know it's no-brainer. We'll probably peg it at close to 400 million, adjusting it for whatever happened in the last 2 months when we started doing the valuation. So we pegged it somewhere there. And then we revisited the same company when a strategic investor was showing interest into that healthcare tech company. Now, what happened was, it was interesting when they raised that funding, then we saw the performance, right? The company was barely able to grow. See, when you raise funds, what is the immediate expectation from a company? You expect the company to skyrocket in terms of growth, right? But when we saw the growth actually kind of went down to like less than 10%. Now, from that standpoint, what we had to do was we had to actually do a down round, right? So we had to actually value it lower than 400 million, which happened. I'm just giving you illustrative numbers. So we had to value it down. And then what happened was, I think after a couple of years, the company again managed to set its direction. At that point in time, I was thinking, I personally thought when I did the valuation, I personally thought that the company is kind of shut down in the next 2-3 years. But then I think there was a redirection which happened in the company. A new strategic investor came on board. They were able to refocus and kind of do the valuation. And at that point in time, when I was trying to do, when I lowered it down, that is the value at which the strategic investor came in. But after 2 years, this company managed to again grow, managed to hit those high growth levels. I mean, growth levels of 100%, 150%. So yeah, you're right. I mean, to answer your question, Abraham, you're right. Sometimes when we look at the valuations which we've done earlier and kind of peg it now, there are some discrepancies or inconsistencies which we see. But more often than not, we are happy when we hit it on the, there are times when we got it right. There are times when things don't happen the way you expected. Did I answer your question?
Yes. So to take on from here, now we've had a situation where we've just valued a company. Let me stay away from the 400 million companies which are normally in your portfolio. Let me say it's a 1 million company, for example,
okay. Yeah.
Which is a pre-revenue type of evaluation which we would have given.
Yes.
Now, after this, we find that, let's say that we had applied a down round. There's not much which you can go down from on 1 million, which is, let's say, about 500,000 maybe you can go to.
Yeah.
But the question now further on is, what is the risk to the valuer? Okay, because this is the fear which most of us have in our minds. If I go and do the valuation of a company and then the valuation falls after that over a period of time, what is it that I should be, what are the risks which I should be cognizant of, and what should I be de-risking against? What should be the mitigating steps which I should take in my valuations?
That's a very interesting thing, right? I mean, I would go back to some of the things which we just discussed. I think Manish also brought it up. Manish Saxena, Manish Chivitsa also brought up some of these points. Even Sameer brought it up during his presentation. Now, what are the key risks when we are looking at the valuation? See, when we are looking at a pre-revenue company specifically, right? We have no operating history. We do not know whether things work or not. So I think I would like to answer this question from a different approach. Let me show you a slide which will help me articulate these things a little better.
Sure.
If that is okay, can I present a slide, Shilpa?
Yes, please.
Yes. Let me know when you get this slide.
Yeah, we can see.
I tried putting a few slides together to help us along the way when we go. So let's approach it slightly differently. What are the common reasons for a startup failure, right? If you're looking at it, right, I mean, more often than not, some of these factors will have close resemblance to some of the methods of valuation which we just saw. We spoke about Berker's method, right, where we talk about how good the management is. When we are saying team problems is a failure, how good the management is one of those points. Lack of product fit, lack of product and market fit. Again, Berker's method, what does it talk about? It talks about a sound idea, a sound prototype, which will be accepted. What are the other things which we are talking about? Is the technology good? Tech problems is what we're looking at. And what are the other things? Financing, funding. So these are all the methods. So when we as a valuer are really valuing a company, these are the factors which I would like to personally look at before providing a value. And more importantly, I'll go back to what Manish Saxena also said. I will also try to corroborate it with another method. I will try to see. So whatever methods we use, like we just discussed, regulators would prefer us to use traditional methods. So we'll stick to traditional methods, but then we can use some of these methods which we also spoke about. Try to bring some quantitative aspect to the pre-revenue companies. when we are bringing that in, right? So what are the key things which we should be looking at? We should be looking at if the management is sound. Okay, I will give you an example. So I am currently valuing a medical tech company, all right, medtech company, and it is being backed by the investors in the current investors, seed investors in the company are one of the largest pharmaceutical companies in India. Okay, when you have the family office of the largest pharmaceutical company in India backing that medtech company, so there is sound backing from investors. And who are the advisors? We're looking at some of the advisors being some of the key biotech people in India, right? Without taking names. Now, when we are looking at such a sound, solid management setup, right? You know that this company will definitely, the chances of failure for this company are less. So when you as a valuer are providing the report, you need to clearly document that, hey, this is an aspect I clearly evaluated. Management team, who are the advisors to this company? These are the sound people. They have proven track record of developing good companies. So that is an aspect which we need to cover. Second, what about the projections? How do we sniff test the projections? For example, I was valuing a retail company recently, and this person is saying that I am making a sale of say around. So it's a startup because it's been there for only 2 years. It's a retail chain, internet retail chain company, something like a big basket. So this guy is saying that, okay, I'm doing 100 crores now. I'll be able to expand in a few, easily to 200, 300 crores. And how? By doubling my cities, by expanding my services to different cities. Now, again, what is the kind of sniff test you'll do? You'll try to see whether there is that addressable market which is really there, which will take this guy's services or not. So those are the kind of, I will challenge the projections in a big way. I will ask the management different questions to see whether the numbers which they have come up with are accurate and are really, will that really happen or not? And I will document all these things, because the reason we have to document is, unfortunately, in our valuation reports, right, we seldom tend to document some of these factors, some of these discussions which we have with management. But documenting those things will help us understand that we've done a scientific job, a good scientific job. And after that, finally, when I come to the value, right, I will do that iterative process which Manish actually mentioned earlier. I will try to see if there is market support for this. In fact, my first step would be to see if there is any market comparables or not, because I cannot stress it more than this, but market support is the most important way for us to mitigate the risks which we have as valuer. You have to say that, okay, here are the companies which I evaluated. These are the 4 companies which I evaluated to whose business models are very close to what I am currently valuing. And this is the contours of growth which those companies achieved. And this company is trying to replicate that. And I'll document all those things. I'll see what multiple I'm getting, implied multiple I'm getting. And I'll also adjust my DCF so that I come to that same value. So in terms of mitigation, right, this is exactly what you need to do. You'll need to stress test the projections. Whatever projections you get, you do not take it at the face value. You try to apply either multiple scenarios or to mitigate that risk of cash flow. The second thing is you'll also try to look at how deep the management is. Is the management good? Can they really pull this off? Are they backed by sound investors? Are they backed by sound advisors? So that is another thing. And in fact, you should go back to the first thing. Is that idea, is it really solving a problem? Is the startup coming up with a solution which is solving a current problem? That is another thing which we need to check. If they are just coming up with a product which is already there, maybe the growth potential of that startup is not going to be much. So, I mean, did I answer that question, Abraham?
I think so. I think that the key to that is mainly to document what we have got by way of information from the management to stress test those projections. So those are very useful suggestions which we've got.
I think market support is very important. Always tie it back to market.
I think that's what I hear from everybody, which is that the most important valuation method is the market approach, which cannot be disputed at any point of time. There is a market transaction to support your valuation, which I think is a very important fact. Yeah.
Absolutely. Manish, you want to add something? Saxena?
Yeah, so I think I completely agree with Arun on the market, having a market comparable to support your valuation is the most important point. But I also want to add one point is that the point which you made, Abraham, earlier, that if you're valuing initially a startup at a 1 million valuation and it becomes 0.5 million, let's say 6 months down the line, I don't see that as a risk, because a valuation of a startup is bound to change in 6 months or 1 year. It may change. We assume that it's going to always change on the upside, but there are cases like what we are experiencing right now, in a pandemic situation where there can be completely unpredictable reasons which could change the valuation on the downside also, right? So that is expected from any valuation to change in future. What the risk we need to ensure is that when we are doing the valuation on that day, we have not missed any information which was available and could have changed the valuation. That's the only risk we need to manage. But if it changes in 6 months or 1 year, that is absolutely fine. I mean, nobody can challenge me for that. So that is how I look at the risk part. Yeah.
Okay, thanks. I just switched to Darshan Rathod, and I'm going to ask Darshan a couple of questions which are, so Darshan, the issue here is that we normally, and this is something which was mentioned by Sameer also, what happens is that the person who wants the valuation done there is a transaction already in place. And you've also done this yourself, I'm sure, in M&A and the other work which you're doing. There's a transaction already in place. And what the valuer is asked to do is to support the value of the transaction. Okay, which is typically what happens with a lot of valuations. So how would you approach this valuation, Darshan?
See, honestly, if there is already a transaction somewhere, which is negotiated, right? And like the last time that since we also work on deals, right? I mean, I think I personally believe that, a third-party transaction between two parties is actually the best value which a company could possibly get, right? We as valuers, more like number crunchers, right? I mean, we really cannot really decide that, Sequoia should invest, money in Oyo rooms at $100 million valuation or $10 million. We are nobody to actually judge that. Mm-hmm. So I think the one key important aspect over there really is to see, there could be two scenarios, right? Where, the parties, right? The company and the company which is investing, or there is a transfer of share, right? Whether they are related or unrelated. So I would, if it's an unrelated party, say, for example, there's a private equity investor investing money in a particular startup, I would really feel more comfortable because in a way it is a comparable transaction, right? Where somebody is ready to give money. And an obnoxious valuation of $500 million, which we as valuers may not even, comprehend why they're investing the money at $500 million valuation. But say, for example, if it's, let's say, for example, you're doing a FEMA valuation, right? And, where there is a related party putting money in a company, in that case, I'll probably be a little bit more cautious just to see that, that the transaction that is happening, the way I'll back it up will be more on an arm's length basis. So that's broadly how it would be. But yes, Abraham, I mean, I think the last session which I gave, I could not stress enough in terms of the importance of market multiples, right? Whether it's comparable companies or comparable transactions. And I believe my other co-panelists also have, similar views, how important it is for us to rely on publicly available data where actual comparable transactions or multiples are available. Of course, with a pinch of salt, because sometimes the data itself may not be absolutely correct, even in databases. But that actually is the best, data source for us to look at multiples. So frankly, I mean, so just to address your question specifically, I would not really bother much, even if you're doing a back calculation, as long as you are comfortable at which, whichever methodology you use, you are comfortable at the value at which the transaction is happening.
Mm-hmm. Right. Okay. So in that case, see, there are a few technical questions which I'll just ask you, which are there from some of the panelists. I mean, from some of the people on the call. So one is that in terms of the terminal growth rate, see, for a pre-revenue company, for us to assume a certain terminal growth rate is a leap of faith, isn't it? So what would you do in this case? How would you get to this terminal growth rate projection? Because that's the bulk of the value is lying in that.
Right. So, honestly, for a startup, if I compare a startup with pretty much like say, for example, a steady state company, right? See, there'll be a horizon period where you will actually estimate your cash flows and then you'll go for your terminal year, right? So say, for example, if it's already an established business, we'll go for, let's say, 5 years or 7 year horizon period, and then we'll go for a terminal. In case of a startup, frankly, I mean, the better thing would be that, see, there'll be multiple stages in which the startup will grow, right? Maybe the terminal growth rate will not come in the next 5 years or 7 years. Probably it will come after 10 years or 15 years, right? And at that point in time, really the terminal growth rate, typically terminal growth rate is, dependent on the, on, at least for us, I mean, the way we look at it is, where is the focus of the business of the enterprises? If the enterprise is primarily focused on, US business, we typically take the terminal growth rate of, the US market per se. If the focus of the enterprise is in India, then we'll take the terminal growth rate of India. Frankly, the terminal growth rate for an established business or startup would not change. I would really say that, the horizon period with which, where when I'm actually specifically, estimating the, the cash flows, I will just increase that for a startup, because they will continue to grow at a higher growth rate, right, over a period of time. And then they'll go into a steady state. And terminal growth rate really talks about a business where it's gone to a steady state. And after that, you don't really expect it to grow at a very, very high, abnormal rate of growth.
Mm-hmm.
I request Manish and Arun if they, and Manish Shiva as well, if they have any alternate view on this.
Absolutely. I think I agree.
Right. What you are being saying, basically, like there being the H model that we look at, like they're being like, because as you rightly said, like in 4 or 5 years or 6 years, the growth will not perish. The growth, so because it will be a high growth stage at that point of time. So we need to look into like a 2-stage model rather than a single stage model.
Use a 2-stage model is one
You're right.
method.
Yeah, I think Manish is right. I mean, that is exactly what we do. I mean, whatever Darshan says, whatever my co-panelists are saying, that makes sense. Typically, I don't think it is right for us to say 5 years you project the cash flows, and if the last year growth, I'm giving you an example again. If the last year of growth is say 40%, suddenly if dropping that 40% to 5%, doesn't really make sense. I mean, it's a no-brainer. That's exactly where whatever Darshan is suggesting and Manish is suggesting would come into play. I mean, by extending it beyond 5 years, right, you're probably trying to taper the growth down. From 40, maybe it'll become 30, maybe 20. I mean, that's an assumption which we as values have to take to kind of factor in the growth, which the company, the high growth, which the company will have still to, it has not lost its steam, right? The company will continue to grow. So you can achieve it either by doing what Darshan is suggesting. That's the simplest way of doing it. The other way is to do what Manish is suggesting. There's something called a variant of DCF. It is called the H model or the fading growth model. It's a simple, instead of Gordon growth, right? It is actually Gordon growth only. Extrapolated Gordon growth is what I would like to call that. You use the H model, it will actually capture that extra high growth period in the terminal value and give you a much higher value than what a typical Gordon growth will throw up.
Right.
Okay.
Yeah. So one point I would like to add on the terminal growth is the concept of matching with the discount rate, right? So when we consider the terminal growth, it has 2 components. One is the real growth and one is the nominal growth. The nominal growth means the inflation which is factored in the cash flows in the long term, right? Now that is also a function of what discount rate you're using and which currency are the cash flows projected in. So if your company is an Indian company and your risk-free rate is derived from the Indian government bond, you're factoring an Indian INR inflation in your discount rate, right? And hence your growth rate should factor the inflation in that Indian currency and in India. And that is where I've seen some valuers getting it wrong, where they are building a US discount rate, starting with the US risk-free rate, but still factoring a growth rate in the INR terms. That will make the valuation wrong. That is also very important when you're considering the terminal growth rate.
Mm-hmm. Okay.
I mean, this happens quite regularly in valuation of IT companies, because their cash flows are, most of the IT companies are Indian companies, but they derive the cash flows in USD terms, right? So their growth is driven by USD inflation. But a lot of valuers still build a INR discount rate, which creates a sort of disconnect between the discount rate and the growth rate. So that's very important to keep in mind. Yeah.
Mm-hmm. Okay. That's something I think we'll have to go into a little bit more in detail in some other session. Hopefully, Manish Saxena will help us with running one more session in future. Let me just try to address, in the interest of time, we will try to address some of the questions which have come in the chat box, and I'll request any of the panelists to take on. So there's a question from Maz, which is, while adopting the multiple approach, do we have to apply a discounting factor to the multiple of the industry stroke company to adjust for the qualitative aspects of the subject company being valued? Any of the panelists can take on. Manish Srivastava? Sorry.
Yeah, so let me take a stab at it. I will ask my panelists to chime in. Yeah, we have to apply a discounting factor. So the first question is, why just a discounting factor? Why cannot it be a premium? If your company has, see, these are the three broad aspects which we look at when we're doing the comparable companies, right? What are the three aspects? We're looking at size, profitability, and growth, right? If your company is smaller than the comparable companies, which obviously it will be, you probably will take a discount. But if you are growing faster than the comparable companies, shouldn't you take a premium, right? And then profitability. I mean, are you profitable? Are your margins better or lesser than the comparable companies? You'll have to again adjust that aspect also here. So the question which Maz had is, do we have to apply a factor? I think every time we do a market approach, we have to really apply we have to really adjust the multiples. It is not as easy as taking a median or a average and straight away using that to value your company. By doing that, what you're trying to do is you're trying to say that this company is in the middle. If the range of multiples you're getting is between, assume revenue multiples you're getting is between 3 to 7, right? You're saying your company is somewhere in between 3 to 7, which may or may not be correct. If your growth parameters, if your size parameters, if your profitability parameters are closer to the highest performing company, right? Your multiple should be closer to 7 or maybe more than 7. So I would suggest that you do this qualitative analysis. Unless you do this qualitative analysis, we are not accurately capturing the value of the company which we are really looking at.
I'll agree to that. So in fact, one of the valuations which we did for a Pune-based company, it was a private company. So the comparable listed companies peers which we got, the listed peers were growing at an average CAGR of about 10 to 12%, and they were their EBITDA margins were around 15%. And our client, their EBITDA margins were about 30%. They were pretty much almost like a monopolistic business, global monopolistic business. And their EBITDA margin 30%, 20% PAT margin they were doing, and extremely healthy cash flows. In fact, as compared to the listed comparables, we gave a premium to the multiple which they were getting traded at, because of course, a company which generates such high cash, which very good growth as well as very good margins would definitely command a premium. And like what Arun mentioned, even if the comparable range is 3 to 7, we'd end up giving a slightly higher multiple than 3 to 7 range, which we found as a comparable.
Right.
So there are other aspects also where you will do qualitative adjustment. I mean, one other aspect which comes to mind is, are you really looking at, is it a purely Indian company versus the comparable companies being MNCs? MNCs listed in India usually command a premium. If you take Maruti Suzuki's multiple and compare it with Suzuki's multiple in Japan, right? Suzuki multiple will be somewhere around 10-ish. And Maruti Suzuki multiple, you guys know higher it is. So in India, MNCs command a premium. So that is another thing which you should adjust. If you're looking at an India company, MNC premium should be adjusted. Market leadership. If you are the market leader in a particular space, that also needs to be adjusted. But that will come in profitability and growth. But yeah, that is market leadership also should be adjusted. That will command another premium.
Abraham, I would like to come in here.
Yeah.
Carry on, Maz.
Yeah. Thank you, Darshan and Arun, for answering the query. Now, just a follow-on question would be, like, if you say the market multiple, the range of the market multiple is about 3 to 7. So by adding a premium or a discount, in case we exceed the range or fall outside of the range, so how do we? I mean, are we allowed to do that, or do we still have to stick within the range itself?
I would say you're absolutely allowed to go out of the range, but you shouldn't go. It's like if the range is between 3 to 7, you shouldn't end up going to 14.
Of course,
as long as it is within reasonable estimates, right? It is if your company is definitely performing much better than the peer set, you are allowed to give more than 7x. If your company is not performing as well as the peer set, you probably would go down a little, maybe even lesser than 3.
But then just to clarify, these are like one of, typically it will be within the range, but these are one of situations where it's an absolute outlier, right? Your client is an absolute outlier, either on the higher side or the lower side, right? Then you'll probably look at being more towards the outliers rather than moving, being in the mid range. So yeah. So this was an absolute one-off case. This particular one in the last 12 years of valuation, this was one case which recently we did, where we, we slightly went above beyond 7. So again, when we say beyond 7, we did somewhere around 7.5. We did not go to 14 like what Arun mentioned. So if that addresses your question. And of course, I mean, there are one or two other things to add on this. See, this particular transaction which we were doing, this was for a minority. Since we were taking listed comparables, we didn't, have any adjustment towards the control premium. Had we taken a comparable transaction with majority, where there were majority transactions, we would have obviously done some discounting towards control. Plus, of course, I mean, the liquidity part also is an important factor. So that also need to be addressed when you are actually discounting or giving a premium to a particular multiple.
Sure. Thank you so much, Darshan and Arun.
If you might allow, I just want to add one thing, and I'd like my co-panelists' view as well on this. My preference typically is to use medians instead of averages. So I just wanted to just have, views of my co-panelists, because in my view, the outliers actually don't affect the multiple as much. So typically my preference is to use medians, but happy to actually have other views.
Median is always better, what I personally believe, and we generally take the median as a practice.
I think this is what we've been hearing from Arun and the others also in their previous presentations.
Yeah, statistically, I see where you're coming, Darshan. That makes more sense. It gives a more central tendency, central figure than an average where outliers are involved. Again, like you pointed out, it's subjective. It depends on the circumstance. So I've also used averages, but my preference is again median.
Yeah. So just to, I would request all, any questions to be raised, please raise them just now. There is just one suggestion which I have to make to Mr. Raghupati, that Shilpa had earlier circulated the link to private companies database. So if you want comparable companies in the Indian context, why don't you give that a try? Private circle database. Okay. And this, of course, Venkat had taken us through this in one of our previous presentations, and I thought that was pretty useful. It's something which it will be good for us to get feedback from those who have used it, apart from Venkat, as to how good or bad that private circle database is. It will be useful for us to see whether we can help our other fellow valuers by getting better rates with the service provider. Okay. Any questions which anybody has to ask, can you please raise it?
Hello?
Yeah,
hello?
Carry on, Gaurang. Gaurang, carry on.
Yes, yes, sir. As the panelist has advised to go for the H model for the growth, okay, where they're advised to, project for at least 10 years, because yes, it is, for the first 5 years, the growths are high, and then suddenly we reduce to 5% as a terminal, 5, 4, 3, any percent for the terminal growth. Please correct me if I'm wrong. Wouldn't be in the current situation, wouldn't be would be riskier to predict for more than 5 years, because the technology changes drastically. The new entrants might, makes our business very risky. So considering this, is it, not riskier to predict for more than 5 years? And the second question is, after the terminal, after let's say 5 years, we predict the perpetuity of the company, which if even if you take it as a 30%, 20%, 10% over the next 5 years, and then we ask for the perpetuity, but over the perpetuity, it would be, between, if we calculate, it would be around 3, 4, 5% only. So just can you please give some light or correct me in this?
Who would like to take this on? Can I ask maybe Darshan, if you want to take on?
I just got a little confused on the question. So whether we should project beyond 5 years is what you're saying, and the second question I didn't understand, Gaurang.
Yes, yes, yes. So, should we project beyond 5 years? First is my question, because it is the time is such that the technology comes into the picture. It's very much riskier. Means predicting for more than 5 years, I feel it's very riskier.
So Gaurang, I mean, my simplistic answer to this, honestly, is ask any promoter, not just a startup founder, but ask an absolute established business. Even if you ask, let's say, the founder of Infosys, the CEO of Infosys, whether you can predict your business beyond 1 year, and you'll really get an answer that the market is so dynamic that any projections beyond 1 year itself will be very subjective. So 5 years, what you're saying. So I would say that the second year projection itself starts becoming, especially when you look at COVID situation itself, right? I mean, something which you would have valued in the 2019. Did anybody in the wildest of dreams would have ever thought about a black swan event like COVID, right? So see, there are always these subjectivities, Gaurang, which keep coming in, right? When you are especially on projections, and hence, probably I'm repeating myself, time and again. The importance of actually relying more on multiples, or at least corroborating your valuation based on multiples, and not just relying on DCF, because you as a valuer are actually taking slightly higher risk when you are focusing only on DCF method, right? Because somewhere all those assumptions, you are also of course you'll take your MRLs, you'll take your management rep letters, you'll take your absolute correspondence recording and all of that, but at the end of the day, let's say if a market, everybody in the market, right, today, if they feel that, see, today, if you see the market is extremely expensive, right? At least in my view, it's extremely expensive. But if that's what the market thinks, right, you as a valuer always have a fallback to justify saying that, hey, there was this bull time, and the market was valuing companies at that. Don't shoot the messenger, right? I'm just actually just putting it up, in the right form and just presenting it to you. So, I mean, but then, so Gaurang, I mean, I don't know if I'm able to address your question, right? I mean, there's always going to be subjectivity, not just in projecting beyond 5 years, but there is subjectivity projecting beyond 2 years itself, right? So that risk is always there, right? And hence, and another thing is that
it would be reasonable.
Yeah, sorry. Gaurang, your voice is break. I'm not able to hear you. Hello. Gaurang, are you there?
Hello?
Are you able to hear Gaurang?
Yes, I'm there. Yes, I'm there.
I can hear now. Yeah.
Hello?
Yeah, Gaurang. Yeah.
Yeah. So just to say that it's
Gaurang, it will be better if you type it out on the chat because your voice is patchy. We're barely able to hear you, Gaurang.
Right. In the meantime, Gaurang, just put it on the chat box if possible. Otherwise, feel free to just route it through an email or our WhatsApp group. And in the meantime, is there any other question from anybody else? If there's any question, feel free to ask. Because I think that most of the questions in the chat box have been covered in some form or the other. Almost everything has been covered by all the panelists.
I have a question. Yes, you can.
Carry on.
Shilpa, you can continue, Shilpa.
Yeah, my question is with respect to convertibles. Okay. Suppose presently the company is issuing CCPS, okay, and the Companies Act gives an option that the conversion ratio can be chosen at a later date as well, okay, or it can be decided now itself, okay. Suppose I go for a valuation right now and I'm issuing CCPS, okay. So how is it, I'm taking a stand that I will, my, valuation is taken. Okay. Conversion ratio is decided now itself. Okay. So what am I deciding right now? Conversion. issue price? Am I deciding what does the law? Actually, Mr. Manish, since you are a company secretary, I would like to have your inputs on this. This is actually Sheetal question, one of the participants. Right now, when you are issuing, what does the Companies Act basically specify? Is it the issue price of CCPS which we have to, relate the valuation to, or should we relate the conversion price from CCPS to equity? Valuation is for what? What does Companies Act specify valuation in this specific aspect of CCPS? Sheetal, I think you have many other points also for the question. You can unmute yourself and ask the speaker.
Sure.
Okay, Shilpa. So like when we are doing the valuation, suppose there is an issuance of the CCPS that is taking place, then we are majorly doing the valuation for the issuance of the CCPS only, because the CCPS that you are issuing, and that is the valuation report that being required. Now, the second part of the question is like, suppose today I being issuing the CCPS and a ratio of 1:1, but the promoter has the right, the company has the right to convert at a later point of time, and at a different, suppose the scenario changes, that what I being issuing today, the CCPS in the ratio 1:1, but later on, after suppose 3 years down the line, it is getting converted, and suppose at that point of time, the business is not doing the way it is, and that being written that the future conversion will be dependent upon the certain terms and conditions. Then at that point of time, again, like when the conversion will be happening, then we again will be doing the valuation for the conversion purpose. So what you are talking about is the two different points at which we are standing.
So in the first stage, when I'm issuing CCPS, I'm not valuing the equity shares of the company, because my purpose of valuation is issue of CCPS. CCPS will be valued.
No, I tell you, firstly, like the CCPS cannot be valued directly. First of all, you have to value the equity shares. Okay. And because the CCPS being suppose coming with certain terms and condition, if the only terms and condition is that it will be in the ratio of 1:1, and there is suppose nothing much of the preferential rights over and above that being there, then we are first valuing the equity shares, and then based on the equity value, we'll be issuing the CCPS. So we'll write in the report like the value of equity shares / CCPS, and in the note we'll write that the conversion ratio is 1:1, and without any further preferential rights that being there. And if suppose the preferential rights being there, then we have to value those preferential rights, and the value of the CCPS will be slightly higher in correspondence to the further rights that the preferential holders will be having.
Sheetal, again, you had many more points.
So let me just address a practical issue, Sheetal. Let me just mention to you. I think that suppose in your example, if there is the situation where you can convert the share at say 1,000 rupees in case certain metrics are not met, and it gets converted at 2,000 rupees in case certain metrics are met. Your question would be, what is the value at which I will value the CCPS maybe? Now, you have to keep in mind, suppose you have a foreign investor coming in. If you have valued the CCPS at 2,000 rupees, and then the foreign investor converts at 1,000 rupees, that's not allowed under FEMA. So a practical situation has arisen where you have to ensure that the valuation is at 1,000 rupees and not more than that from the viewpoint of FEMA. Okay, so from this point, let me just take on and ask if any of the panelists have an alternative viewpoint as to how to handle the situation, which is partly addressing what Sheetal wants.
Yeah.
So Darshan, you have any thoughts? Manish, Srivastava, you're the one who would be actually facing these problems day in and day out, I'm sure.
Actually, that is the situation. Like when we are issuing the CCPS, then we take, first of all, look into what are the terms of the CCPS. So we broadly look into what are the terms, and if suppose there being certain preferential rights that being attached, then we have to find the value based on those preferential rights. And but the very first thing, we need to find the value of the equity, because ultimately the CCPS is getting converted into equity shares. So we need to correlate with the equity shares value only.
Yeah. So Sheetal, you carry on from here, because in case it's not clear to you, I think that you should ask further.
Yeah, actually, the thing is that in my view, companies, when the agreement is there, in the agreement, the formula is already mentioned that as per this formula, 5 years down the line, this will be the conversion ratio, or this is how the CCPS will be converted. So, if after 5 years, if the the mentioned conversion ratio is 1:1, but the actual conversion happens, I mean, in the chat box, I have mentioned that example also, one equity for 1.5 CCPS. So this is okay without any valuation of shares by the valuer. Can they go? Because here there could be 0.75 CCPS.
So, if I can add here,
Yes,
so
carry on.
we have done a lot of these valuations not for Companies Act but for financial reporting under Ind AS and IFRS, where such type of conversion ratios, change the nature of instrument from equity to a debt or derivative. So what we typically do is we use a derivative pricing model like a binomial model or a Monte Carlo simulation to predict the future equity value. So as Manish Srivastava mentioned, the starting point is always the current equity value, right? But the conversion is not going to happen on the date of your valuation. It is going to happen at a future point in time. So what we do is we start with the current equity value and then we simulate that equity value under multiple scenarios. For let's say if the conversion period is 5 years, we'll start with the current equity value, create multiple scenarios of equity value in the future. And under each scenario, we will calculate what will be the value of CCPS, because if your conversion formula changes based on the equity value, your value will be different, right? And then we roll it back to present value. That is what we do for financial reporting, but I'm not sure if from Companies Act and perspective, if the regulator will be able to understand these option pricing methods or not, and it will become an issue, So I don't have that experience of doing for Companies Act purposes. Yeah.
So, Manish, let me also just add here. I think, that is a process which we also typically follow. But I frankly believe that it shouldn't change for Companies Act. Because the valuation principles are same, and frankly, it shouldn't change. I would be interested to know if it really changes. Some of the RVs, here can actually help us understand that.
The issue is going to be FEMA sometimes, because you can't afford to convert at a rate which is lower than basically what FEMA says is that in case there is a value of a shares which has been fixed, you cannot, the foreign investor come in at a rate lower than the fair market value of the shares which has been fixed. So therefore, if you convert at a lower rate, you have an issue under FEMA. So that's one of the things which needs to be avoided in a valuation.
Yeah, FMR challenge is always there, especially when you're setting the floor price or when you're setting the cap. Depending on whatever situation, that aspect is always there, which we need to handle.
But if FEMA is not there, then?
So I would do what Manish Saxena was saying. I will probably do a simulation, Monte Carlo simulation, try to come up with different estimates of equity value in the future and then roll it back to the present value.
How about the back-solve method? Sorry, carry on, Sheetal.
But is the valuation at all required?
In the first place? See,
from Companies Act perspective or any particular regulation perspective.
See, again, from a Companies Act perspective, we may not be able to comment, but what Manish Srivastava was also saying is that you still need to do the valuation. Your valuation is always derived based on your equity value, right? Your CCPS has to be based on the equity value. It cannot be standalone number. The conversion happens from the equity, right? So you'll need to derive the equity value and to get to wherever you need to come up with the CCPS value. I'm not sure from a Companies Act how that will apply. Manish Saxena, do you have a comment?
So as I mentioned, I'm not aware of the regulatory requirement because we don't have that practical experience for doing for Companies Act, but we have done a lot of these valuations for IFRS, and Ind AS. So under Indian accounting standards also now, any company which is issuing these structured instruments like a CCPS or OCPS or just preferred shares needs to bifurcate that instrument into liability, equity, and derivative. And each component gets accounted separately. Like if the entire instrument is, if the ratio is fixed, let's say the CCPS was such that the ratio was 1:1, then it will be treated as an equity under Ind AS now. But if the ratio was variable, which is the example which has been shared in the chat box, which was dependent on the company value, was variable, it will become a derivative, a liability derivative, which will mean that it will be mark to market going forward. And that is where a valuation will be required.
So, in case of CCPS, as far as my knowledge is concerned, and the company sides, if as Manish said, if the ratio is fixed upfront, you are deriving the value from that of the equity. So you need to value the equity first, and then based on the ratio of conversion ratio, you need to fix the value of the CCPS, and then you need to recommend the fair value of the CCPS based on the valuation of equity and conversion ratio. If the conversion ratio is not fixed, still you have to value the CCPS, but the conversion ratio, if it depends on the fair market value at the time of conversion, the principal and the plus coupon rollback is actually your value of the CCPS. To that extent, you have to recommend, and again, you need to perform the valuation at the time of conversion also, because the conversion depends on the fair market value of the equity. In case the conversion is not fixed upfront, you need valuation at 2 points. At the time of issue, it is simply face value plus coupon rollback based on the, and in case of at the time of conversion also, because this is ascertained by through fair market value of the equity, you have to perform the valuation of equity shares at that time, and then you have to recommend the conversion price. That is my opinion. In case of, as far as Companies Act is concerned, FEMA regulations, of course, you have to keep in mind.
So you mean to say is that even if as per the agreement, even if it is decided that this will be the conversion formula, that will not impact.
If the conversion is fixed upfront, at the time of conversion, you don't have to perform the valuation. But if when the conversion is fixed upfront, you need to do the valuation at the time of issue of the CCPS itself, because you don't know what is the issue fair price of the issue price. No, you have to fix that based on the valuation of equity.
Right, at the time of issuance, it will be required. And that time itself, if they decide that this will be the conversion formula 5 years down the line, then 5 years later also this
you don't need valuation at that time. If the conversion is fixed upfront, you don't need valuation at the time of conversion.
Okay.
Yeah, is right. If
you have to stick to that conversion decision, whatever has been made.
Correct.
Yeah, I believe that there is an option with the issuer. If the conversion ratio is not fixed upfront, then you need to take the valuation at the point of the conversion. Then
conversion also.
Correct.
Right. I think that we've had a pretty useful session so far. So, and I'm assuming that there are no further questions because we've not heard anything more. Shilpa, can we conclude?
Yeah, yes, please.
Okay. So let me first and foremost thank Sameer for that context setting. He came up with some very useful methods which have given us a lot of food for thought. Some of us, of course, disagreed with some of the methods which Sameer presented. But what is valuation without a bit of disagreement between valuers as to what is the right approach to follow? So, Sameer, I think that you've raised a lot of interesting approaches and methods for us to follow, and thank you for that. And we look forward to further sessions with you and to further interaction with you, which will help us to learn. Thank you for that. Let me thank Manish Saxena. As we normally do when we come away from sessions with Manish Saxena, we always have learned something new. We have got a bit more of technical knowledge courtesy Manish, and I think that he is pretty well read and knowledgeable about how to handle valuations, and that's very useful for us. Thank you, Manish, for having taken part in this session this time as well.
Thanks for having me.
Pleasure. So Arun Ratnam, of course, brings a different perspective. And that, I think, is, apart from the technical perspective, Arun brings in a perspective which is different and gives us the ability to look at something from, like when we looked at the healthcare, I think that the approach which we were following before we heard from Arun about healthcare was somewhat slightly different. So what we realize is that industry perspective from Arun is something which counts a lot. And like we did last time, I think we have taken away something more in this session as well. And thank you for that, Arun. We look forward to further interaction with you also.
Thank you for having me. Always a pleasure.
And also what you did for us, Arun, is that you made our session quite fruitful because you took on so many of the questions. You attacked them really. So thank you for that. It gave us a lot of knowledge. Let me thank Darshan Rathod also. Darshan, I think that it's pretty useful. You gave a perspective which is also from the viewpoint of the smaller valuers. Most of us are small valuers. We have to keep that in mind. We are not of the same scale and size as, say, Manish Saxena or Arun Ratnam. So you're representing a lot of us, I think, when you come up with the perspectives which you do. And thank you for bringing those perspectives to our discussion today. Right. Thanks, Arun, Darshan. So Manish Srivastava, of course, like we did last time, we've taken away a lot from what you've done. And it looks like working with Sameer, and between you and Sameer, you've actually put together a fair bit of knowledge in your organization. And that's looking like a path which other valuers like us have to follow. So you're setting the guide path for smaller valuers. I hope that all of us have taken away from whatever you've come up with today, Manish, and thank you for that.
Thank you. Thank you.
Right. Let me also say that the presentation which Sameer made was very colorful and very attractive. So you've got a good design specialist backing you up, Sameer, and that's a very good thing to have for people like us when we need to make presentations to clients. It's useful to have something like that, right? So thank you to all the panelists and to Sameer for having carried out this session so usefully. Let me also thank Shilpa for having put this together, and to Mayur, who as usual has helped a lot in getting this whole program out. I must also thank Subbarao for having put together most of the memberships. He is the one who bears the brunt, I think, when some of the valuer members ask for CEP certificates. Just keep in mind that it takes about a month for you to get your CEP certificates. And it will happen. Keep in mind that most of us are volunteers. Most of us are valuers. We attend these sessions from the viewpoint of getting further knowledge to help us in our practice. And I believe that most of us have achieved that objective today. So let me thank all the participants today. Subhajit from Calcutta, then we have people from Tamil Nadu, we have people from Mumbai also. We had Joy Jain from Gurgaon. So thanks to everybody from all over the country for having attended this session and for making this a useful Saturday morning. Thank you.
Thank you. Thank you.
I request the participants to, either volunteer to be a speaker, or you can suggest any of your connects, to be a speaker, or any topics which you would be interested in. Basically, this is all for valuers by valuers. So let us make, many more sessions which are useful for all of us. Thank you. Have a happy weekend.
I request few participants, okay, to talk about this session, okay, how it is useful to you. Then it will be useful for us in future, okay, to conduct more sessions like this. Any participants, okay, you can express your views.
Okay, thank you, everybody. I think we'll bring the session to a close. Thanks.